love the channel and find it useful in becoming a happy retiree. Subscribe today. We talked about now we're on this 9th year or the 9th anniversary of the bull market this past week. The 3 things that could make the market, or let's call it, could start to end this run. 1, markets get expensive and overvalued. Today markets are not trading at a low multiple. That I wouldn't call it cheap, but it's certainly not overly expensive because profits have kept up. Profits have pushed this market higher. The market has not just inflated itself due to greed, at least not yet. So that's number 1, that this bull market run ends when markets do get excessively expensive. Number 2, some sort of exogenous shock that we just can't predict, whether it's a policy error or some sort of just global event that happens that we have no control of and cannot foresee. That, of course, can throw markets into a tailspin. And then number 3, and this is why the jobs data was so important this week, wage inflation. Wage inflation is the killer dagger when it comes to markets and economic growth. It almost always, once you get wage inflation, companies starting to have to pay workers at an accelerated pace in the 4% plus accelerated rate of growth every single year. That's when it starts to eat into their profits. That all of a sudden starts the kind of this downward cycle. Instead of earnings expanding for big companies, they start to contract. It also, so that in itself starts to slow down the economy. It's not good for the jobs market at a certain point. So that's the number that the market was kind of on pins and needles for this week. Hey, what was the one thing that started the February 2018 correction? It was wage inflation. That Wall Street got very nervous when markets printed a 2.9% wage inflation number, average hourly earnings. That is the data point that Wall Street really keys in on. And we've been talking about that for a couple of years here. We're always on watch for that number. And this past Friday, the jobs report, it looks as though that is still in check. So average hourly earnings year over year clipped in at about 2.6%. And we can live with 2.6%. It's still a long way to go before you get to that scary line that is the 4% number. So we have some room, we have some runway before we get there. What's to like about the jobs number? Well, 313,000 new jobs. That was the establishment survey. It's the payroll data. We also saw labor force participation climb. We went from 62.7 to 63. Might not sound like a lot, but 1/3% on an economy as big as ours. That is a very big number. It's about 800,000 new folks entered back into the labor force. And now, so that means that when labor force participation ticks up, those are people that now raise their hand and say, okay, now I'm back in the job market. It's not as though it's just a bunch of people graduating all of a sudden entering. It's individuals making the decision to go back to work. Maybe they look around, they say, I haven't been working for a long time. Looks like there's a lot more choice than when I last looked. So I'm going to enter back into the labor force. And that really impacted, that's a number, that labor force participation number impacts the supply of people looking for jobs. That number was 800,000 new folks looking for work in the month of February. Most of which, and this is a separate survey called the household survey, so it's a little different than the establishment survey, 785,000 of those people, 800,000 new folks looking for jobs, found a job. It's a big number. And that's why we saw, because even though we had this giant influx of new people looking, we had a giant influx of new jobs, so the unemployment rate stayed at 4.1%. So a ton of a newfound people looking for work and an equally large group of people finding jobs, and very little wage inflation to speak of for the month of February. Hence, for now, we're okay. We're okay for now, meaning that for the time being, we don't have to worry just yet about wage inflation, which is, again, the black widow of economic data points, still in check. So this benign inflation data has kept the Fed from getting jumpy. And we don't want a jumpy Fed. We don't want an aggressive Federal Reserve. And the market still sees over the course of this year 3 small rate hikes. The worry back in February, or from the January jobs report, is that, hey, we've got wage inflation, the Fed has to get real aggressive, and they're going to raise rates 4 times, maybe 5 times this year. That at least for now, is off the table. And we're back to this gradual rise, probably 3 times this year, 1/4 percentage point every time. So this just gradual move higher for interest rates, which markets can, when it's done gradually and methodically like we think it's going to be, it's a lot easier for the markets to digest. And at least that's the path that looks as though will continue. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.